But one farmer says, seems to me there was a tea party in Boston that was illegal too.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold.
We shall seek to establish and maintain a dollar which will not change its purchasing and debt-paying power during the succeeding generation.
As anguished shrieks rose up from the floor of the New York Stock Exchange.
Government credit and government currency are really one and the same thing. A reserve of gold and a small reserve of silver.
Why do central banks hold it?
Well, it's a form of reserves.
Why don't they hold diamonds?
Well, it's tradition, long-term tradition.
Well, some people still think it's money.
Good morning. Welcome back to the Junius Maltby channel. For your daily gold motivation, the Walter Cronkite, as I'm told, of precious metals. There is a lot of boring content to go over today. Article 1, Why Gold, Not Bitcoin, is the ultimate play from Kitco News. Gold is the ultimate play, and countries are setting up exchanges, and the Chinese government and the Russian government are buying gold. They're not buying Bitcoin. That's the ultimate play. That's the ultimate currency. That's what governments are going to tie their currencies to if and when something bad is going to happen from an inflationary perspective. Mancini told Kitco News on the sidelines of the 121 Mining Investment Conference in New York. It's going to be gold. It's not going to be Bitcoin. On gold's rally this year, Mancini attributes the run-up to monetary policies. The spike was on news that the Fed is starting to ease now and that we're going to easier monetary policy, and I think that's what's driving the gold price higher. This parallels a lot of the information we read about and saw in discussing the Netherlands and how their central bank is really focusing on gold if there is an economic reset. And I believe the central banks are in tune with this. They have their finger on the pulse. They know what's coming. Now let's look at some more information that's out this morning and this week to really get into the weeds on this. Gold during global monetary ease. Ladies and gentlemen, another round of global monetary easing has just begun. More than 30 central banks around the world have cut interest rates this year. Amid trade wars and slowing economic growth and subdued inflation, the Fed cut the federal funds rate twice this year, each time by 25 basis points. In September, the ECB cut its deposit rate from minus 0.4% to minus 0.5% and reintroduced its quantitative easing, while the People's Bank of China cut the reserve ratio by 50 basis points to 13% for large banks. The third time this year, releasing about $126 billion in liquidity to support the slowing economy. In August, the Reserve Bank of New Zealand surprised investors with 50 basis point interest rate cut. The central banks of Hong Kong, Thailand, Mexico, Turkey, and Russia also have cut rates recently, while the Bank of Japan may join the club soon. The fresh round of global monetary easing ends the short period when major central banks talked of, and some even tried, to normalize the monetary policy after all the unconventional measures undertaken in the aftermath of the Great Recession. The Fed probably advanced the most, but even the U.S. Central Bank failed to return the interest rates and its balance sheets fully back to pre-recession levels. The last time when the central banks eased their monetary policies in such a unison was during the financial crisis. Today's situation is not as grave as in 2008, or so they say, but the central banks all around the world take the trade tensions and the U.S. yield curve inversion seriously. They worry about the risk of recession and try to prevent it or to cushion the blow. And we're seeing a lot of talk of recession. You're going to see an article coming up that speaks about it possibly being even next to fall because it won't be happening this year. What does the global monetary ease mean for the gold market? Generally speaking, the central banker's about face seems to be very bullish for the yellow metal. The lower policy rates should translate into lower real interest rates, while some bond yields may fall even further into negative territory. Thus, the environment of low interest rates and elevated recessionary risk, otherwise, the central banks would not ease their stance, is fundamentally supportive for the gold prices. What is particularly encouraging is that the Fed is also easing its monetary policy. it implies that the divergence in monetary policy will not widen, or it may even narrow somewhat. Abstracting from the QE, the ECB cut its target rate by 10 basis points, while the Fed by 50 basis points, which is a fundamental reason for a weaker US dollar, which could remove some downward pressure from the gold market. Let's take a look at the chart below, which presents the long-term history of the gold prices and the federal funds rate. As you can see, although the price of gold did not always rise during the Fed's easing cycles, the last two instances were positive for the shiny metal. Chart 1, gold prices, yellow line, right axis, London PM fix in dollars, and the federal funds rate is the green line, left axis in percent, from January 1971 to August 2019. What is crucial here is that the Fed's easing cycles were accompanied by the narrowing divergence in the long-term interest rates in the United States and the Eurozone. The chart below shows the difference between the 10-year Treasury yields in both areas and the federal funds rate. As one can see, when the Fed was cutting interest rates, the spread was usually diminishing or even becoming negative. And here you see the spread between the 10-year U.S. and Euro area government bonds. Blue line, right axis in percentage, and the federal funds rate is the green line, left axis in percentage, from January 71 to August 2019. The federal funds rate and interest rate spread between U.S. and the Euro area. And the source for this is the Federal Reserve Bank of St. Louis. It is a great piece of news for the gold bulls. As the chart above shows, the difference between interest rates in America and in Europe is at record highs. This is what has recently supported the value of the greenback, keeping gold from rallying more intensely. Now with the Fed's new easing cycle, the spread may diminish somewhat. It means that there is further room for the gold prices to go up in the medium term, if it does indeed translate into lower US dollar values. And all of you know, how often and how long have we called the dollar the leper with the most fingers left? It's not safe. It just happens to be one of the safest bets for the individuals that hold it and these institutions. When the dollar falters, and it will, you know that, I know that, it's inevitable. That is when you're really going to see, as Peter Schiff puts it, that beach ball held underwater effect. Gold being the beach ball, suppressed, held under. Look at it. The U.S. government values gold currently at $42 an ounce. That's the official on-the-books valuation. Okay, and when this unravels, when the dollar finally ends up in its grave, its final resting place, that is when gold will shine the brightest. And you will not be able to get it. I don't know how many times I've had to reiterate that fact. You will not be able to purchase gold for any amount of fiat at some point. Of course, that's not today. That might not be tomorrow. It's not next month. But there will come a time where it will be unobtainium. However, the precious metals investors should be aware that the dovish U-turn among the central banks may boost risky assets in the short term at the expense of safe haven assets such as gold. But unless recessionary worries soften, this effect should not be too strong. After all, the central banks ease their monetary policies because they fear recession. In such an environment, luckily for gold, the risk appetite should be limited. Yes, we will see pullbacks. We will see profit-taking, sell-offs, speculation, day trading. You've got a lot of people moving paper gold back and forth, and there are times where gold will retreat, and it causes people to be shaken or question. Oh, I don't know. Gold pulled back. It's not 1,500. It's below that. It's the key is we know certain levels it's not going to. It's not going back to 11. It's not going back to 12. It's most likely not even going to go back to $1,300 an ounce. It's going to trade in the range we're seeing currently, and then eventually it's going to explode. And that's what we are holding and waiting for. And this is why some believe we are entering gold's most powerful bull market yet. And I am in that camp. And again, I never like to predict the exact valuations in dollars or even the times of when these things will occur. But I do believe we are in the timeline in which gold will have its most powerful run, its biggest bull market yet. And it's setting the stage. It's building to that point right now. The storm clouds are on the horizon for the global economy. And there are things in motion that we have been able to see clear as day in the headlines, in the articles, in numbers, in statistics. We know what's happening. Now it's just make the right move and wait. What happens to gold when you combine all of the following? Hundreds of millions of U.S. savers earning a pittance on their cash, even less than they lose each year to inflation. That's a huge thing. That 1 point alone, when you look at the interest savers are suffering to endure, the loss of wealth and savings because of the interest rates, because banks are getting free, easy money. Number two, countless bond investors overseas who don't even make that much. Their yield is below zero, even before inflation. They're losing money on bonds. The highest recession probability in more than a decade. Big key point there. We're seeing it everywhere. Everybody's talking about recession. Everybody's preparing for it. It is coming. Number four, stable supply for the precious metal and rapidly rising investor demand. Think of this, and we've talked about this key point often. How few people, how rare it is to even be a purchaser of gold. I mean, you look at the wealth of the middle class, the United States and overseas, just globally, it's a very small percentage of people that allocate any form of savings and pay any attention whatsoever to precious metals, both gold and silver. So there's very, I would say, little consumer demand for the precious metals outside of central bank activity. I mean, the biggest consumer demand is really just jewelry. Less than 1% of Americans, as you know, have ever held gold outside of jewelry. They've never seen or held a bullion coin or even a gold sovereign. What happens when this becomes more mainstream, which it does in times of economic uncertainty, risk, hyperinflationary events, it's a herd mentality. Eventually there is a stampede. The bolt of lightning strikes, the thunder echoes, and they run for it. And when that happens, when they're running for the gold or they're running for the fire exits, you already want to be outside. You already want to be in a safe position because the price at that point will escalate quickly, supplies will diminish and even disappear, and you won't be able to obtain the precious metal that you wish to at that point. So you want to be ahead of the curve. You don't want to invest with the crowd. Be ahead of the crowd. Number five is the huge surge in gold buying by central banks. Again, another point we've talked about, reiterated, and broadcast on here on the Junius Maltby channel numerous times. If you're new here, there's some old videos you can watch and you'll learn those points quickly. But most of you that are here all the time know and have seen what central banks are doing. And they are hoarding gold like never before. So what does all this mean? Well, you get the most powerful gold bull market of modern times. That is what is setting up. This is not just a forecast of the future. It's already happening. We've been talking about it here for years. And we're barely in the first inning, as he says. And this is a guy that says, look, I'm not even a traditional gold bug. There are times when he recommended we sell. And there's times he just preferred to recommend other investments. And that's not me. However, some investors, that's how they play the game. But starting more than a year ago, he warned of more challenging times in the equity and risky bond markets and laid out a very bullish case for gold. I like to see articles like this because it's nice to see an individual who's really not so entrenched in gold that he can kind of see it from another perspective. And yeah, he's in it just to make maybe a quick buck, or he's an investor, he's guiding others, and that's not my job. I don't sell gold, I'm not an investor, I don't get anything out of this. It's just my perspective and me passing on this information, as I've reminded you guys in the past. I'm just a medium in which this information passes through. But let's go on here. If you followed the roadmap, you've done very well for yourself. Consider the last 12 months. Just owning the SPDR gold shares, which I don't like, is paper gold, could have made you about 20%. That's more than twice the 8.5% you'd have earned owning the SPDR S&P. And in another recent period this year, gold bullion absolutely crushed the S&P 500 by 21 to 1. That's bullion. In the gold mining stocks, which can go up many times more than the underlying metal, the potential gains are many times greater. However, I will argue, gold mining stocks are also more risky. Sometimes people buy gold mining stocks and they get beat up because that particular company might not be as successful. There's setbacks, problems with the mines, and therefore the stock price just doesn't follow the valuation of gold. You might see a huge spike in bullion prices, and a particular mining stock might not earn you anything. And it's one of the reasons why I don't like paper. I don't like the stocks. I don't like the paper mining stocks. If I'm going to put money into gold, it's going to be in the physical metal, and it's going to be in my possession. Key point here, I'll never stray from that fact. Hopefully, you've enjoyed the fruits of these moves, but if, again he says, but if I'm right about the overall market backdrop, you haven't seen anything yet. The overwhelming majority of potential buyers have not yet gotten on board with metals and miners. There are still hordes of investors who think recession risk is off the table and that chaos insurance in the form of gold isn't required. His word to them is good luck with that. And that is exactly what they're going to need. Good luck. You see it on the financial networks routinely. They'll have a panel, they'll have a pro-gold guy, guys like Peter Schiff and such, and then they'll have the opposing view. And it's amazing to see so many people convinced and articulating what they consider a sound argument against gold with the backdrop of what we're seeing in today's economy. And there's a lot of people that run with that. And there's a lot of people that listen to them and pay zero attention. I know some very wealthy individuals who don't own even a scrap, not even a piece of gold dust. The only gold those individuals may have is a ring on their finger. If that, some of them don't even own that. They might have a tungsten ring. And I'm telling you, when these individuals, if they do, that's a huge if they do happen to wake up or pay attention and decide to allocate some of their wealth towards gold, just a small measurable percentage of that class of people here in just the United States, I'm not even talking about the UK or the Eurozone, just here in the United States, you would see a major consumption of bullion at that point. And I think you would then see the price reflect that. And they're going to not be the only ones. It would be global. And again, they're competing with central banks who are getting money for free. So that should tell you something. If someone's giving you billions of dollars for free, and you have the opportunity to allocate that billions of dollars towards gold to save your bank because of the economic backdrop, what are you going to do? You're going to buy gold. You're going to take bullion off the market. And that is what we will see occur eventually. You cannot compete. Right now you have the opportunity to compete with central banks in the consumption of precious metals. There will come a time where you will not be competitive. You will not have enough capital, enough paper to push it towards gold. Again, always remember they're the closest to the spigot. The financial institutions are the closest to the tap. They get those inflationary dollars first, so they are able to spend them into circulation and to purchase goods and services and commodities before you with pre-inflationary dollars. By the time those dollars trickle down to you, the metal prices have already been impacted by the financial institutions and the central bank buying activity, and the prices have escalated. So the time to buy is before those institutions, before those banks, before those hedge fund managers, before the wealthier class decides to move towards gold. If you're ahead of them, you're going to be getting gold at a discount, which is right now. Effect of QE4 on the stock market and gold. Do you really need to read an article to know the effect of QE4 on gold? I would hope not. But for those that are new to the program, and just for our own entertainment to explore such boring information, let's read it. The Fed is already like an out-of-control weather vane in the eye of a hurricane. First it blows one way and then the other. Having detected the first winds of the back wall of the hurricane, we have been in the eye since 2009. They are scrambling with indecent haste into QE4, which, of necessity, given the much more extreme conditions that now prevail, will end up being on a much vaster scale than the previous bouts of QE. What this means is that the dollar is toast. Let's read that part again. What this means is that the dollar is toast, or will be before much longer. We should not be fooled, however, by the dollar index holding up, which of course it could do if other countries are debasing their currencies at the same rate. Big key point there. Sometimes the dollar looks strong, and again, that's because it's the leper with the most fingers left. If you are on a sinking ship, it's small comfort to know that the other ships around you are sinking too. Instead, we will be able to tell what is happening to it by its performance measured in gold. Gold has been subject to ridicule again in recent years because it has underperformed the stock market, in some people's opinion, with the old barbarous relic jibe making a reappearance. So here it is, worth reminding ourselves that gold has still outperformed the stock market by a factor of about 2.5 to 1 since the start of the new millennium. That is a point you don't hear anybody talk about on the mainstream networks. They just don't want to acknowledge it. No one wants to acknowledge the performance of gold. As we can see on the latest 20-year chart for gold against the S&P 500, given what the Fed has been doing to the money supply in recent years, it is remarkable that the dollar has held up as well as it has. But that is only because, taking a leaf out of the Fed's copybook, other countries and trading blocs like the European Union have been subjecting their currencies to even more abuse. Nevertheless, the pattern forming in the dollar does not look positive. It is suspected that a giant broadening top is completing in the dollar index, and it appears to be struggling beneath the resistance level shown on our 20-year chart for the index. An important point to make here is that for the elites, it presumably makes more sense for the markets to crash during the fall of next year rather than this year. Very important point here. We talked about this in the beginning of the video, about why we might see the recession next year. The reason is that a crash before the presidential election would inflict the maximum damage on Trump, who has made a buoyant stock market a major plank of his presidency. So if they go at it, pumping money again with QE4, they could keep the stock market elevated, provided that they are able to firefight any liquidity issues arising from the increasing extreme instability. If not, and things get out of control, markets will crash anyway. Action late last week suggests that for a while at least, we are going back to risk-on mode, which could see the stock market make new highs in safe haven assets, which both the dollar and gold are now. Drop back, and we see that both the dollar and gold dropped back late last week. Gold's chart has been weakening with a potential intermediate top forming, and its latest COTs are by normal standards bearish, with the commercials now holding heavy short positions, which usually means trouble. Any significant reaction from here will be viewed as presenting a great opportunity to build positions across the sector, because QE4 will eventually cut the legs from under the dollar, leading to, cue the drum roll, hyperinflation. JP Morgan warns U.S. money market stress to get much worse. JP Morgan Chase & Company says the money market stress that sent short-term borrowing rates surging last month is likely to get much worse despite the Federal Reserve's attempts to inject billions of dollars into the financial system. The Fed has offered overnight loans and started buying up to $60 billion of U.S. Treasury bills a month in an effort to ease pressure in the vast repo market, where banks typically lend their assets in exchange for short-term financing. Secured lending rates shot up in late September, with analysts pointing to scarcity of interbank reserves as well as regulations that limit the size of banks' balance sheets and their repo lending capacity as the potential culprits. JP Morgan says it's not convinced the Fed has resolved the issues in the funding markets, according to a note from analysts led by Joshua Younger in New York. Funding pressures resurfaced last week, even after primary dealers, firms approved to trade directly with the Fed, took all of the available overnight liquidity from the central bank and sold it as many T-bills as possible. Given the benefits of our newfound perspective, we recommend viewing these moves as highlighting the limitations of the Fed's chosen solution to their operational issues, the analysts wrote. With year-end coming up, this is all likely to get much worse, in our view, before it gets better. J.P. Morgan's note follows similar warnings from Bank of America, Merrill Lynch, and Goldman Sachs Group, who have also attributed September's funding stresses to factors including post-financial crisis bank regulation. Even after the Fed's latest moves to ease the logjam in funding markets, intermediation bottlenecks remain, Goldman Sachs said. Analysts at sell-side banks have argued for the creation of a standing repo facility by the Fed that would allow banks to continuously exchange their securities with the central bank in exchange for cash. Meanwhile, J.P. Morgan Chief Executive Officer, Jamie Dimon, that guy, said his bank, still one of the biggest players in the repo market, was unable to calm or profit from the dislocation in funding markets last month because of regulation. So the banks want less regulation. These guys are setting themselves up. Okay, the cartel boys, these banksters, these gangsters of Wall Street, they're trying to move themselves into a position. Okay, they are, I guess you could say, manipulating and lobbying the government to get themselves in a position, I believe, to really take the cream off the top on this final go-around. And need I remind you, the amount of corruption, the spoofing, the scandal surrounding J.P. Morgan with precious metals. Look at what they have done with silver. These guys are criminals, and they are going to position themselves in metal while performing their criminal activity. Fed tolls the bell for gold, US $2,000, and I think that's a conservative estimate. We're very close already, and it's coming. The Fed's actions will weaken the US dollar, and everyone will go back into the gold market. Both points we've covered recently and even in this video already. One big point here is last week's announcement that the Fed intends to buy $60 billion of bills per month until mid-2020 certainly is QE on a massive scale. As such, the total monetary base should rise by almost $500 billion to $3.76 trillion by June 30th, 2020. Remember, there's only about $4.5 to $5 trillion worth of gold ever mined since the beginning of time above ground on the planet. So these guys are basically printing the value of gold non-stop around the clock, flooding the world with baseless, unbacked, garbage, trash paper fiat. The real reason gold is surging and why it won't stop, geopolitics, monetary policy, a slowing economy have all been cited as primary factors behind gold's bullish breakout in 2019. While these catalysts cannot be discounted, the real reason gold is surging, and while it will continue to do so, is the trend in real interest rates relative to inflation. That's this individual Sam Borges' opinion here as a journalist. We continue to see further information, more articles, more opinions, more discussions related to gold, interest rates, the health of the global economy, the strength of currencies, all of it pointing towards a bullish market for gold in the long term and potentially explosive price reactions in the precious metals realm. So stay tuned in here on the Junius Maltby channel as we hunt for clues, news, and information related to the price trajectory of precious metals. Thanks for being here. Don't forget to like, share, and subscribe.